revenue up 62%, net income surging 65%, and $32 billion in cash pulled in within a single quarter. NVIDIA once again crushed every claim that the AI boom is fading, with a truly alien-level earnings report. But now, with this giant sitting at a $4.05 trillion market cap and trading at 36 times earnings, has the future already been fully priced in? Is NVIDIA the greatest compounding machine in human history, or a valuation trap that leaves zero room for error? What's up everyone, welcome back to Stock Market Breakdown. When you look at NVIDIA's earnings, you can't just stare at the flashing headline numbers, you have to understand the operating leverage behind them. NVIDIA has now entered a truly frightening phase. Profit growth is starting to outpace revenue growth, but as the world's most valuable company, is also facing unprecedented pressure from what I call perfect expectations. NVIDIA's fiscal year 2026 third quarter results once again reset investor expectations. Revenue jumped 62% year-over-year to $57 billion, while net income climbed an even more astonishing 65%, reaching roughly $32 billion. This divergence between revenue and profit sends a critical financial signal. NVIDIA's fixed costs are now fully absorbed through massive scale. The company has entered a classic operating leverage expansion phase, where each incremental dollar of revenue delivers a larger share of profit. Earnings growth has effectively entered a self-reinforcing compounding cycle. You need to understand just how powerful this kind of compounding really is. It shows NVIDIA isn't just good at selling products, it's elite at monetizing growth efficiently. When profit growth consistently outpaces revenue growth, it means the company no longer needs proportional increases in spending to expand. The most resilient metric on NVIDIA's income statement is gross margin. This quarter, NVIDIA sustained an extraordinary 73% gross margin, number that borders on mythical in the hardware manufacturing world. Maintaining margins above 70% over time is the ultimate proof of absolute pricing power. It means that even when supply chain costs fluctuate, NVIDIA can fully pass those costs downstream thanks to product scarcity, converting revenue into massive cash flow with incredible efficiency. So, what does a 73% gross margin really mean? It means every major tech company on the planet is effectively working for Jensen Huang in the semiconductor industry. Almost no one can sustain margins like this. It proves NVIDIA's products aren't commodities, they're allocations. Many investors still think NVIDIA is just a hardware company selling H100 or Blackwell chips. In reality, its true competitive advantage lies in the CUDA software ecosystem. This deeply integrated hardware plus software stack has conditioned millions of developers worldwide to build directly on NVIDIA's architecture. Migration costs are enormous, and ecosystem fragmentation carries real risk. This full-stack moat makes it extraordinarily difficult for competitors to break in, keeping NVIDIA firmly at the center of global AI infrastructure. CUDA is NVIDIA's real moat. Hardware can be replaced, ecosystems cannot. Developers' deep dependence on CUDA has effectively created a technological no-fly zone. Even if a competitor launches a chip with better specs on paper, without a mature software stack and developer ecosystem, NVIDIA's dominance remains largely untouchable. In capital markets, cash flow is always the ultimate truth. NVIDIA's free cash flow for fiscal year 2025 reached an astonishing $61 billion for a company with a $4.05 trillion market cap. Future share price performance no longer hinges on AI hype or sentiment-driven narratives. It depends entirely on whether this massive cash flow can continue compounding at an annual rate of 20% to 25%. Only real, sustained cash returns can justify a valuation of this magnitude. We need to throw out the flashy metrics and focus relentlessly on cash flow. What does a $4.05 trillion valuation actually imply? It means the market demands astronomical levels of free cash flow year after year. If cash flow growth even slightly decelerates despite earnings still rising, valuation framework could shift violently. NVIDIA currently trades at roughly 46 times earnings as the most valuable company on earth. This multiple implies that the market has already priced in several years of near-perfect execution. NVIDIA doesn't just need to grow, it needs to beat expectations that are already extraordinarily high. If the valuation multiple were to compress toward a more typical 30x range, profit growth would need to accelerate fast enough to offset the enormous downside pressure on the stock. A 46x divided by it doesn't look crazy for a small cap growth stock, but on a $4.05 trillion titan, the margin for error is razor thin. NVIDIA can't afford to stumble. Even a minor guidance cut could trigger massive market cap evaporation. This is the definition of a high wire act. NVIDIA's growth engine is now undergoing a structural shift from simply selling chips to cloud providers toward deep penetration into vertical industries. The company has partnered with pharmaceutical giant Eli Lilly, committing $1 billion to build AI labs for drug discovery. These moves into healthcare, robotics, and digital twins show NVIDIA transforming raw compute into real-world productivity tools. This vertical expansion is shaping up to be NVIDIA's most critical second growth curve, heading into fiscal 2026 and beyond. Bottom line, NVIDIA has evolved from a hardware company into the operating system of the global AI economy. While a 46x valuation undeniably means the stock is dancing at altitude, its push into verticals like healthcare and robotics reveals its ambition beyond the data center era. This is Stock Market Breakdown. I'll see you in the next one.